Welcome back. When it comes to banks, most people just go with the flow. They go with whatever is familiar, whatever their parents used, whatever was easiest at the time. And once they've picked something, they just stay there forever. And I'm here to tell you it's to your benefit to be a little choosier. At the end of the day, banks are tools. And the first rule of tools is simple. Use it well, but don't get married to your hammer. So let's talk about how banks actually work and how to position yourself inside the banking system so that all the intricacies of time in banking work for you and not against you. Number one, banking relationships are not all equal. There is a fundamental difference between a debit account and a credit account. And most people have never had this broken down. A debit account holds your money. Your paycheck lands there. Your rent or your mortgage payment gets deducted from there. Your savings sit there. And here's the thing. If you meet bank KYC requirements, many banks won't ask many more questions before taking your money. Yes, they want your deposits. Yes, they will compete for them. But at the end of the day, it is still just your money. If you leave, you take your money with you. To the bank, there is still little to no risk to their bottom line. A credit account is completely different. An overdraft, a loan, a credit card, or a line of credit, that is the bank's money. The bank is lending you its capital. The bank is fronting you its own money and then trusting you to pay the bank back. And that subtle difference changes everything. When a bank decides who they will lend to, they won't casually dole it out. Banks will stringently check and closely monitor your payment history, your financial behavior, your spending patterns, and all of it over an extended period of time. They want to know, has this person borrowed before? Did they pay it back? Did they pay it back on time? That data, built slowly over months and years, is what turns you from a stranger into a trusted borrower. Every additional month of responsible usage signals dependable trust. Any monthly payment percentage less than 100% signals grave risk of default. In credit, the past is everything. So have a perfect past. This is why the 80-20 rule applies directly to credit. Your first credit account does the heavy lifting. It starts the clock. It builds the history. It turns you from invisible to legible. Later accounts add tools. But that first account, that is the unlock. Now here is where most people get it wrong. They are impatient. They want the premium card on day one. They want the high limit immediately. They want the mortgage pre-approval before they have earned the trust. But banks do not think in days. Banks think in months and years. And here is the thing, time is going to pass anyway. The question is whether you are using it. So apply early. Use credit responsibly. Pay it back on time. And let the history build quietly in the background. Because 3 years from now, that quiet history becomes the key that unlocks the next door. Now, let's talk about which banks to use. And this is where most people make their second mistake. They pick one bank and stay loyal to it, as if loyalty is a virtue in a system that doesn't reciprocate it. The smarter move is to bank across multiple institutions and to be deliberate about which kind of institution you choose. Every market has its disruptors. Canada has Wealth Simple. The UK has Monzo. The US has Robinhood. These are incredible products, low fees, great interfaces, genuinely useful. Bank with them. Use them for what they are good at. But don't stop there, because the tools that actually travel with you across borders, across systems, across decades are the established behemoths. Visa, MasterCard, Amex. The point isn't to doggedly choose either or. Get all of them. You don't need to choose between a knife, a fork, or a spoon. Get the full ensemble. Heck, go grab chopsticks and grab a napkin as well. Get Wise. Get Revolut. So you can move money across borders without getting quietly taxed on every single transfer. Get an HSBC account, both debit and credit, so you can carry your bank relationship from one country to the next before you even land. Utilize Amex's global transfer program to take your credit history from your home country and port it right alongside you into your new country and abode. To recap, here is the mental model. Disruptors give you the best products right now. Behemoths give you the best access over time. Don't choose either or get both. The disruptor without the behemoth leaves you stranded at a border when you want to move. The behemoth without the disruptor leaves money and convenience on the table every single day. So here's the Grand Arbitrage approach to banking. First, understand the difference between your money and the bank's money. Debit is yours, credit is theirs. Treat them accordingly. Second, start building credit early. The first account does the most work. Do not wait until you need credit to build it. Third, bank with disruptors for the products. Bank with behemoths for the infrastructure. Fourth, think in years and decades, not hours and days. The relationships you build quietly today will fling open doors later. And fifth, don't marry a hammer. The best bank is not the one your parents used. The best bank is the one that gives you the most leverage for where you are going. That is how banks actually work. And now that you know this, so can you. This is Grand Arbitrage, and I'll see you in the next one.